What if I told you? The number you've been obsessing over, the number that decides whether you qualify for a home, a car, a credit card, or even an apartment, was never designed to make you wealthy. It was designed to make you predictable. Predictable as a borrower. I'm Adam, and today we're going to unpack a truth most people never question. Your credit score may not be a tool for freedom. It may be a tool for control. And once you understand how the system really works, you'll never look at those 3 digits the same way again. From a young age, we're taught something very specific. Build your credit. Start early. Open a credit card. Never close old accounts. Keep your utilization low. It's treated like a rite of passage into adulthood. But notice something. No one teaches you how to build wealth in school. No one teaches you how to negotiate salary. No one teaches you how to evaluate investments. But they absolutely teach you how to become a responsible borrower. Why? Because the system depends on borrowers, not savers, not investors. Borrowers. Let's break something down clearly. A credit score does not measure how much money you have, how much you've invested, whether you own assets, whether you're financially independent, whether you can retire comfortably. It measures one thing, how reliably you repay borrowed money. That's it. If you have zero debt, 0 credit cards, 0 loans, and you live completely within your means, your credit score won't reflect financial strength. In fact, it may barely exist. Because the system doesn't reward independence. It rewards engagement. You've heard of the 5 components: payment history, credit utilization, length of credit history, credit mix, new credit inquiries. Let's decode them. Payment history rewards you for making payments on debt. Credit utilization rewards you for using debt, but not too much. Length of credit history rewards you for staying in the system longer. Credit mix rewards you for having multiple types of debt. Auto loans, credit cards, mortgages, different flavors of borrowing. New credit inquiries penalize you for seeking too much credit too quickly, but not for already being deeply in debt. The formula never asks, are you financially free? It asks, are you a stable profit source? Here's something most people misunderstand. A high credit score doesn't mean banks trust you. It means banks want you. You are low risk, predictable, profitable. Credit card companies don't make billions from people who avoid debt. They make billions from interest charges, late fees, annual fees, balance transfers, long-term repayment cycles. Even when you pay on time, they still profit. Because interest is baked into the structure, and if you carry balances, that's exponential profit. The better your score, the more offers you receive, higher limits, premium cards, luxury financing. Congratulations, you've unlocked access to more debt. This system isn't just financial, it's psychological. You're trained to feel proud of your credit score. It becomes a status symbol. People brag about 800 scores like it's a trophy. But what is it really? It's a measurement of how effectively you manage obligations. Imagine if we celebrated emergency funds, passive income streams, debt-free living, investment returns. But we don't. Because those don't benefit lenders. They benefit you. And systems don't reward what they can't monetize. Think about advertising, 0% financing, buy now, pay later, low monthly payments. Notice the focus? Monthly payments. Not total cost. The system conditions you to think in payments, not ownership, not long-term impact. If you can afford the payment, you're told it's responsible. But affordability is not measured by payment size. It's measured by financial resilience. And debt quietly erodes resilience. Here's the part most people underestimate. Interest compounds against you just as powerfully as investments compound for you. A $10,000 balance at 20% interest, if only minimum payments are made, can take years to eliminate and cost thousands more. Now, multiply that across millions of households. That's not accidental, that's structural. The credit system is designed to maximize lifetime value per borrower, and lifetime value increases when balances last longer. Now, let's be balanced. Not all debt is destructive. A mortgage can build equity. A business loan can generate income. Student loans can increase earning potential. But here's the difference. Strategic debt builds assets. Lifestyle debt builds liabilities. The system doesn't distinguish between the two. Your score improves either way. Whether you finance rental property or luxury vacations, the number goes up. But your net worth may not. True financial power looks different. It looks like 6 months of expenses saved, minimal high-interest debt, investments generating returns, skills that increase income, low fixed expenses, high flexibility. If your income stopped tomorrow, how long could you survive without borrowing? That number matters more than any credit score because survival without debt is leverage. So, what do? You don't reject credit. You outgrow dependence on it. Here's how. Maintain a solid score, but don't obsess over perfection. Never carry high-interest balances unnecessarily. Use credit for assets that grow value, not consumption. Track net worth more than your score. Increase income faster than lifestyle. Build investments that reduce reliance on financing. You want the ability to borrow without the need to borrow. That's power. Your credit score is not your identity. It's not your success metric. It's not your wealth indicator. It's a risk assessment tool for lenders. Once you understand that, the emotional weight disappears. You stop chasing validation and start building independence. And independence is the opposite of profitable for them. Or